Welcome to Let's Talk Investing, a co-production of the Globe and Mail and the Investor Education Fund. I'm Rob Carrick, personal finance columnist at the Globe and Mail, and with me is Gail Bebee. Gail is a personal finance speaker, and she's the author of No Hype, The Straight Goods on Investing. Gail and I are going to talk about some finer points of being an effective investor. Gail, I wonder if you could talk about some of the pitfalls that prevent investors from getting good results. What are the big problems they run into?
Well, four major ones. One, they don't have an investment plan. Two, they have an investment plan and they don't follow it. Three, they're not smart shoppers when it comes to choosing a financial advisor or choosing specific investments. And four, they don't know the investing basics, so they don't know enough to ask the right questions.
Now, how do you know if you need an advisor or not? Because there's two groups of investors out there. There's the advised, and there's the people muddling along on their own, and then there's the smart do-it-yourselfers. I guess that's three groups. Yeah. How do you know which one you belong into, and how do you make sure you're in the right spot?
Well, one of the things you can do is take a look at some of the evaluation tools which are available on the internet, on discount brokers, or available from financial advisors to assess your tolerance for risk, your particular financial goals, and what kind of portfolio you should have. So if you're a person who comes out that very conservative portfolio and you don't like to take risk, well, you know personally, you know yourself that you will spend time working on your portfolio, you might be able to go it alone.
Let's talk a bit about risk, because that's sort of one of the key factors in building a properly designed portfolio. Before the market crashed last year, a lot of people thought they were reasonably comfortable with risk. Now they're probably a little bit too gun-shy at risk. How do you effectively decide how much risk you should build into a portfolio?
Well, looking back at those evaluation tools, and I did run through one last night to just see that they will ask you questions saying, okay, would you be comfortable if you earned a 10% return over 10 years if in any 1 year you could lose 10%? And that will give you an indication of how much risk you're ready to take when you go through one of those evaluation tools.
What's your sense of whether investors are taking too much or too little risk in their portfolios?
Well, certainly up until last year, I think investors were taking too much risk. Now, I think they might be the opposite. So it goes back to my have an investment plan and stick to it.
Now, what does it look like when a portfolio has too much risk? Is that generally too much exposure to the stock market?
Generally, too much exposure to the stock market, but it could be exposure to so-called fixed income products that turned out to be much higher risk than I thought. For example, the asset-backed commercial paper, which was sold as an alternative to money markets a few years back.
Okay, last question. Let's focus on the people who are maybe too gun-shy about risk right now. Would those be the people with all those billions of dollars stashed in money market funds right now?
And earning no interest?
Earning no interest.
Yes.
What do you urge those people to do?
They should go and talk to their financial advisor and review their investment plan. I don't think any investment plan should be all invested in money market funds. You need a certain amount of stocks for the inflation protection.
Okay, thanks, Gail.
Thanks, Rob.